So let's get more on this and really ask the question, is the RBA too hawkish in its GDP forecast? Well, Roger Montgomery from Montgomery Investments joins us at the desk right now. Roger, what do you think? Because the data is pretty weak and the RBA is remaining pretty glass half full.
Yeah, I think they're optimistic in their expectations. I think that we're going to see GDP slowing considerably, and they'll not only be forced to revise their forecasts lower, they'll probably have to cut rates. Maybe even twice this year.
Before we get into that in a bit more detail, the retail sales number today is first sort of sign of consumption this year, I guess, and there was a lot of thought. We had Gareth Aird on from CBA earlier, and he was saying they thought perhaps it would start to pick up this year and maybe it was a second half story, but the weakness in the retail sales read today shows that it's come into 2019. I
think what investors have to understand is this is just the beginning. What we're actually seeing, and we might even have some charts on this, but one of the charts is a chart of building approvals, which is a great leading indicator for housing starts. And that's it there. And so there's actually, what we're actually going to see now is we're going to see a drop-off. We've seen a drop-off in residential approvals. We're actually going to see now a significant drop-off in building activity, which is only delayed by a few months, of course. You get your approval and then you start to build. So there's only a short delay. Now, think about the way that rolls out. Lower building activity means less jobs for chippies, less jobs for plumbers, less jobs for sparkies. The construction industry is the third largest employer in this country, and that means there's less income. Now, to be fair, builders were fully employed, more than fully employed over recent years.
They were over-earning. Highest wages.
Indeed, they were over-earning. You go up the northern beaches of Sydney and you can just have a look at the houses they live in. You know, you just think, hang on a sec, you hammer a nail. You know, how do you get a $7 million house? So they've been over-earning. Now they're going to be earning less. Now, that doesn't mean that there's a recession coming, but what it means is that spending, discretionary spending, is going to be pulled back. So we saw only a few days ago the car sales numbers around Australia. And, you know, I've got friends who are in the car industry. They own dealerships or they're dealer principals, and they've seen year-on-year declines of up to 40%. So the first thing, the most sensitive thing to wealth, or to a decline in wealth, is vehicle sales, believe it or not.
Should we look at the consumer categories and wealth effect? Because we've got a chart on the wealth effect. And it's interesting because the RBA was saying yesterday cars and furniture are the only places really to be hit by the wealth effect. It's limited. It's a pretty big part, though, of the economy. So you
can see you've got car sales way over on the left-hand side with decreasing sensitivity as you move across to the right. But what's interesting is in the retail sales numbers that came out today is that we actually saw the start of declines in household goods, the start in declines for appliances. So only in October this year, appliances were still growing year on year. Furniture was still growing year on year. Household goods still growing year on year. That's all turned much, much lower now. And so if you're thinking longer term rather than just about this print, this number, if you're thinking about the next 6 to 12 months, it's going to get worse because of that first chart that we showed on the program today.
The leading indicator.
Which is a leading indicator of less activity. So there's less intentions, we can see that, and that's going to lead to lower activity, lower wages and so forth.
So, Roger, I don't want to criticise the RBA, and I've been saying this today, and I certainly don't want to talk up, the idea of rate cuts in the economy, but it just seems like, a lot of the economists we have on the show are talking about these leading indicators. Why is it that the RBA wants to wait until they actually see unemployment rise?
Look, it's really simple. They're in the confidence game. Right? The last thing they want to do is trigger a panic of any description. I'm not triggering a panic because I'm not forecasting a recession. But we are going to slow down further than what the RBA is suggesting. So the other thing that's really important to understand is that when chippies spend less, it affects the retail sector, which is what we've just described. The retail sector is the second largest employer. Now, speaking of employment, we know that in any year there's an election, the intentions of businesses to hire people drops as well.
Just because of the uncertainty?
The uncertainty. So they're just not hiring. So we could actually see, it might be that we've already seen the best we're going to see in employment, and unemployment starts to tick up now as well. And that compounds the debt stress that we're already seeing coming through.
Have we seen a drop-off already in construction employment, or has that not shown through yet?
It's not coming through yet.
Okay. But it is expected, obviously.
Oh, absolutely. Villa World was a classic example in the half-year reports when they came out. Villa World reported 444 residential lot sales or thereabouts. In the prior half, not the corresponding half, but the half to June 30, they sold 950 lots.
Yep.
So they've seen a 50% decline in residential lot sales. That's telling you that they've just got less work on.
Yep. So my question is, when it comes to rate cuts, if you're assuming there are rate cuts from the RBA, is timing important? When should they move? Because, you know, you've got most economists saying July, August is when we'll see the first move by the RBA, but some are saying, oh, now that we've seen retail sales, perhaps it'll be brought forward. Well,
the great thing that the RBA has that the US Federal Reserve doesn't have is the ability to cut more if necessary.
Not much more though, right?
Well, they don't have to cut by 25, they can cut by 50. You know, they've got room to move.
Would they do that when they're already at 1.5%? We're already pretty low?
Like I said earlier, they're playing a confidence game. So, you know, they'd rather that the prospects appear bright and that people keep spending. And 60% of our economy is consumption. So they want people to keep spending, but it is slowing down. We've seen foot traffic, January and December foot traffic numbers fell off a cliff. Retail sales year on year and month on month are declining substantially. So you can't say that the foot traffic numbers are lower because people are buying online. Total retail sales numbers are down. So it's all starting to play out now, and it really means that investors might have the opportunity to get some really attractive prices in things like Harvey Norman, JB Hi-Fi, Nick Scali, sometime in the next 12 months.
But, you know, would you want to invest in them with the growth prospects?
Oh, absolutely, because as, you know, the forwards, I think there's a famous myth, I don't know whether it's true or not, but Greek philosophers, the best Greek philosophers centuries ago were asked the question, summarise the world and everything, and they said this too will pass. So it will pass and things will get better again in the future, and so we'll be in a position to actually make money out of retail. I think this year the market overreacts to the downside and we get the opportunity to buy these things cheap.
But you're not forecasting recession?
No, I don't think so. I think we get a serious slowdown. But at this stage, I think the probability of a recession might be 15 or 20% at the most. OK. Well, Roger Montgomery, we really appreciate your time on the program. It's such an interesting sort of domestic picture at the moment for the economy. So thank you very much for joining us.
A pleasure.
With those insights.